Okay, we're going to start today off with looking at the market movers. S&P's up a little bit today, less than 1%. We had a good earnings report by American Express today. Yesterday we had MasterCard and Visa, so they're all bunching together. I think the summary of the credit cards is that the economy is doing really good. There's no sign of customer slowdown in purchases. So it looks like they revised GDP fourth quarter of last year to be 3% growth. So you need two negative GDP quarters in a row to be a recession. So it looks like the economy is doing pretty good. We have some slowdown, but doesn't look like we're going to be in a wipeout, negative, super negative, no one's spending money environment. So let's look at the top movers in the S&P for today. We have American Express. I think what you'll see in this is all discretionary spending. Discretionary means things that people don't really need, but they get anyways. And we have the things doing bad revolving around chips. We have Intel that came out with a pretty bad report yesterday, earnings report, and all the chips kind of fall together. And we have oil going down today. So let's look at let me see. Look at Okay, so we can see that the price of oil is going down 2%. That's why the oil companies are down. But we're seeing what's happening at the beginning of the year. We had a switch in mindsets. I think we talked about this the first talk of the year. It's like whatever worked last year, it'll sometimes it's opposite. So right now what's happening in the top 10, things that worked last year are not working this year. And it's the opposite way. We have more conservative, dividend paying, are being thrown by the wayside, and the things that are working the best are the things that went down the most last year. So it's almost a change of guard right now. We're having the tech stocks outperform this year. So let's look at the Visa. They had a good report yesterday. American Express, they go together. And let me see. Okay, so I'm noticing that a lot of the telecom companies are starting to do better. Verizon was down 25% last year. Now I think we have to think, this is the third week in January. It seems like there's a switch in investors' mindsets. They're trying to pick up the stocks that went down the most last year, and the ones that were more conservative last year are going to be not performing as well this year. So if we look at our calendar, we still have in December we had 3% GDP growth. So if we have any recession, it would have to start in sometime in this year, because we need 2 quarters in a row of negative GDP growth. So regardless of if we have a recession or not, we're still trying to find quality companies and hold them. So I'm pretty consistent with my portfolio. I still believe in the big tech stocks. Right now, we're at the end of we're right here. We're going to have the Fed have a meeting next week. So that is going to be what everyone's waiting for. We'll have basically the market's going to be like sideways Monday or Tuesday, waiting for this to see what the Fed is going to do. You see. So also next week, we're having earnings. This is we mapped out yesterday. Apple, in Meta, and Philip Morris are on Wednesday. We have Amazon on Thursday. Google is going to come on Monday. So we're going to see a lot of fluctuation in the markets based on what those bellwether stocks are going to report. So a lot of these stocks are giving us indications that they're tightening their purse strings, like Google is laying off people, Meta is laying off people, Amazon is. So I'm sure that they're not going to have as good earnings as they were last time this year. So they're all struggling right now in this environment. But the good stocks, they'll continue the growth rates after a year or so, after we get out of this recession. Okay, so what the other things we look forward to, we have another holiday in February 20th. Usually people are happy around that time, so we usually have a better market at that time. We also have next week the rest of the tech earnings. And then we have basically nothing until the end of, let me see, what do we have here? We have end of quarter window dressing in March. So that's the big picture here. But we have the tech sector was rocked last year for a negative 30% or more, and now they're just basically recovering, and it's a reversion to the mean. All right, so let's go to our talking points. The 10-year and the 2-year are up 4%, 1.2% since last week. It seems as though, and the Fed is reducing their balance sheet still. So this year is going to be basically sideways to going back to a PEG ratio of 1 for a lot of stocks. So a lot of stocks could be bouncing back and forth between a PEG ratio of 1 at the minimum to higher. We saw Tesla 1 or 2 weeks ago. We said it's fairly valued because it went down to a PEG ratio of 1, and it just basically popped 50% from that. So we're going to keep our eye on whenever stocks crash. Like, for instance, today, Intel crashed 10%. I'm going to look at that stock just to see if we find a hidden gem. Because whenever stocks crash, we have to look at what their projections are and see if it's even worth looking into. So catalyst for the market to go up. This is earnings season, so tech earnings are coming out. Tesla had a good earnings report this week. That's making the stock go up a lot. Google and Apple and the rest of the tech sector is the next week or two. We are overbought, and we're pretty much overbought across the board. And we're hovering around the 200-day moving average. And it's if we look at our S&P, the moving average, this is the 300-day moving average right here, this purple line. This right here is the 200-day moving average. And you see we're getting close to the 200-day moving average. If a majority of stocks in the stock market get above that 200-day moving average and stay above it, and then these moving averages start to turn up, that's a very good indication that we have momentum, and the stock market, we're getting to a normal situation in the stock market again. So this is the 50-day moving average. It's turning up. It's been up for a while now. And the 200-day is still going down. But we're looking, over time, if 200-day goes up and a majority of stocks in the market are above the 200-day moving average, that is the momentum we need to have a normal market that's going up again. But we don't have that yet. It's still going down. All right, so, but you can see from our chart, we've actually broken out. We started last week. We saw this breakout last week, and we said that we have this extraordinary move advanced declines, the BAM, that's breadth 2-to-1 ratio for a period of 10 days. That is an indication that we have enough possibly to break out of this. Let's hope that works. This could very well turn into be a bear market rally. Everyone in this, that's an observer of the stock market and on TV is observing this, meaning, well, is this a fake out or a breakout? And if it's a fake out, we're going to be back down here in this downward trend. But for me, I'm just looking at this as normal market gyrations, and things will be back to normal in a year or so. But if you're positioning and buying into positions and you have some cash, you have to keep track of this to dollar cost. All right, so let's look at our meeting notes. Hold on. Okay, so meeting notes are, okay, oil is up 2%. It went down today, but it's, the theory for oil is, right now oil is 82 is considered a lower number for oil, but China is reopening. We know that oil price follows demand and supply. So if China reopens and there's a lot of demand for oil, then the price goes up. And as the dollar goes down, all commodities prices go up. So you have two things working in the favor of price of oil going up. And if we get indication that the economy is doing good, that's also an indication there's high demand for oil. So that we had a GDP print of 3% in the fourth quarter. That was good. So that could help the price of oil. And inflation is still around 6.5%, and dollar index is flat from last week. So we can't really say anything about that this week. Okay, so we're sticking with our plan for this year. We're trying to dollar cost in the stocks. It has a possibility of being a crazy year, but whenever stocks big ratio of 1 that are quality stocks, that's when you start looking to accumulate them. And if you buy it above the PEG ratio 1, you have to realize it's selling at a premium. And stocks that will do good this year are, I don't know, this was our beginning of the year plans: consumer staples, food, alcohol, utilities, healthcare. That did good last year, but we might be just flipping, and things that did good last year that were conservative, paid a dividend, will underperform. That remains to be seen, and it all depends on how the economy goes. So, let's look at the sector ETFs. What is going on? I think oil is down the most. Yeah, oil is down because the price of oil is down 2%. Energy. Okay, semiconductor is down because Intel gave a bad report, and all the chips go down with Intel. Healthcare. So I think we're seeing consumer staples. We're just basically seeing a flip today. What worked last year is underperforming today, anyways. And the things that are doing the best, consumer discretionary, things that people don't need, like a new jewelry or whatever, that those are things that people don't need, that whenever there's a good economy, people buy more of. So let's see, home builders. We're seeing a recovery in the home builders. We were talking, the time to start buying the home builders was when the interest rates, when people were throwing this out. And we're looking at our calendar. Let's look at our calendar. Interest rates will start, home demand returns. So if you're looking into a possible home builder investment, we think the home when the interest rates start rising again next January, that interest rates start declining next January, that's when people will start jumping into homes again. And because homes have a people start buying their homes in the springtime. So we're thinking spring is whenever home demand returns and things get back to normal there. So if you're interested in home builder stocks, you would dollar cost your investment from the time you start, was maybe 2 months ago when we started talking about this, to, maybe things are back to normal here. All right, so let's see, what else do we see here? Technology is doing good. Okay, so this is a flip from last year. Last year, the home builders, they were crushed, and real estate did bad. Technology did bad. Okay, so this could be an indication with the S&P crossing and breaking out possibly of this. We have some momentum to take us out of this. It could be that we're flipping what worked last year and what will work this year. All right, now let's look what else I'm going to talk about. Right now. Okay, so there's a lot of market participants that are looking at the same thing we're looking at. And this guy, he says, surely it's not going to be that simple. And we can see he noticed that little breakout like I did. And 200-day moving average, you can see that it's still going negative. It's the blue line. And is it a fake or not? If it's not, we're going back down here. So we're just following this pattern, and we very well could have enough to break us out of there. But next week is going to be key because we have a lot of earnings reports that could kick the market into gear. So let's look at this breakaway momentum that we've been talking about for a month now. So the last time this flashed was right around the pandemic. 4/6/2020. You can see this breakaway momentum happened right before big moves in the market. Here it is right here. This is the year 2020, 2008. So you have these red dots in this long chart. So it's an unproven thing, but it seems to be working so far. We're bouncing off of that time, and it's going up, breaking out of our downward channel. So it only happened 29 times, this breakaway momentum, since 1945. And there's all kind of graphs in Twitter that people are following. And usually, 1 year after the breakaway momentum, we're higher than where we are now. So for me, I'm just casually observing this, knowing that I'm fully invested, but you have to know what to keep your mind, your emotions in check, and just keep track of this for your own fun and enjoyment. All right, so here are the 1 year returns after breakaway momentum, and they didn't have 2020 in this graph, but it should have been. But pretty good returns. Now, we just also like to keep in mind that two pretty smart people, Dan Niles and Leon Cooperman, says we're sideways for the next year. So there's a 50% chance that we're just going to be going sideways to down. So let me see. DXY, unchanged. It's still in a downtrend. This is good for materials. It's good for gold. It's good for oil. The more that the dollar goes down, the more commodities are worth. And when a dollar goes down, that helps all the multinationals. And fear and greed, we're getting greedier every week. So what's happening in the stock market now is there's fear of missing out. We were talking about that word a month ago. Whenever we do break out of this, when we break out, let's look at the S&P. When we do break out of this, people are going to realize, oh man, I don't have some of the quality stocks that went down 50%. I'm going to jump in to what went down the most last year. And that's kind of what fear of missing out is. And when we get to extreme greed, then we start getting momentum and people just start piling on, and then you have a rally of 10% in a week. I mean, that's the kind of thing that happens. But you got to be invested in dollar cost, in to be able to realize those returns. So another thing that you look at when we look at this this chart is that I'd say 80% or more of the gains since 1940 happened in, let's say, the best 100 trading days. So if you take away the best 100 trading days of the stock market, then your returns go down exponentially. You get like a 0% return versus a 50% return over time. So you have to be always invested and have that mindset of if it goes down and everything stays the same, buy more. So, okay, so VIX is going down. It's down to 18 now. You can see that 18 is, it's one of the lowest levels that we've had in the past year. Actually, it is pretty much a low, the lowest we've had in a year. That's right. But if it's an inverse correlation to the S&P, so you can see as the S&P, which is in red, goes up, the VIX goes down, and vice versa. So a lot of people for the past year have been using the VIX at 18 to start selling their positions and waiting for a market drop. But what's happening right now is it looks like we have momentum, and if you have momentum, the people start piling on, and then the VIX goes down to 15 or 13. So we don't know what's going to happen. We're still at an inflection point. But I think what Peter Lynch said once is it's time in the market. It's not timing the market. We're trying to time the market here, but for me, it's time in the market. You got to be at least invested a little bit, to have some skin in the game. Otherwise, you're just guessing all the time. All right, so we have an article that came out this week. Google is being sued for their monopolistic, I think it's advertising software. And so there's a government the government is having an antitrust case against them. There was a warning about this 2 weeks ago, and there's like these hints that it was going to come out. So it wasn't like when news hit, it wasn't news. It was just, oh, okay, they're doing it again. This is the second time they're hit with an antitrust case. The important thing to realize, this it's not an open and shut case. Like they have monopoly, they have 90% of search. It's illegal. It's, they don't actually sell, for 99% of their income, they don't actually sell a product. The users get it for free. And the users actually get a benefit. So it's not an open and shut case they're going to lose, number one. Things you think in mind, things to have in mind whenever something like this happens. Microsoft went through the same thing with the Internet Explorer. They bundled the Internet Explorer with Windows, which seems so petty right now, but they had to go through years of litigation for that. And they were distracted. They did not get into phones. They could have had the dominant operating system in the world for phones, but they didn't put, Bill Gates says he didn't put his best engineers on that project. And that distracted them enough where they didn't capitalize on the mobile revolution. So what the big problem is for Google is they have competition with AI now from this ChatGPT, and they have competition from video from TikTok. They're so distracted. They're going to be distracted with this, and they're not going to concentrate on those projects. They're going to be putting a lot of effort into fighting this antitrust cases. There's 2 of them now. So what that does for investors, like for me, I'm reducing my confidence level in Google, maybe from 98 down to 95% confident in the company. So whenever that happens, you gotta Um, well, you have to reconsider your investment. Maybe you have lesser percent of your money in, the stock if it's not going to have as um, if your confidence drops in the company. But this is going to take like 6 years to go through this process. So by then they'll earn a lot more money. But they obviously, what else? Okay. So what I did was I just checked on Google's earnings, and they're still growing around 15%, 10% this year, which isn't bad for a recession. That was last year. 15% this year, 18% next year. So they're still growing around 15%. But how much are they going to lose when they can't aggressively invest like they used to? If they're being watched by the government, they're not going to be taking companies over, and it just makes the confidence level in Google go down a little bit. Okay, so it's fairly valued now, but there's competition and they're being tracked by the government, which could affect these numbers. Right now they're 15% a year, but we'll see. Okay, another article, American Express CEO, they had earnings, and they said we aren't seeing recessionary signals. That is exactly what we want to see. That means the economy is not falling apart. The customers are still spending, and it seems like it doesn't seem like, from what he said, we're going into a recessionary period. So so for a lot of indications that we see, the economy's doing pretty good, and we're not going to have a collapse in demand, and companies aren't going to drop a lot, like in a financial crisis. So let me see. But that's why the American Express was up today. They had really good earnings, and that helped the Visa and MasterCard too. All right. On the other side of the coin, we had a report from Intel. We talked about this like a year ago or more. We talked about Intel compared against Taiwan Semiconductor. We said that Intel Taiwan Semiconductor at that time was probably better stock to buy than Intel. Intel is like a battleship you got to turn around. It had to it lost its edge. Like AMD was taking over a lot of its business, and they weren't making chips as good as AMD. So they're turning. It's like a turnaround story right now. But right now they're missing their estimates. This earnings report was really bad. Because of that, Intel used to be a bellwether stock. I mean, like something like GE. GE used to be one of the biggest companies in the market, and everyone said as GE goes, so goes the rest of the market. And Intel was the same way for the tech sector maybe 10 years ago. But now it doesn't have as much clout. I looked at the earnings estimates for Intel. Negative 34% last year, 40% for the next year, and 20% the year after. So its PE is around 17 now, and it's grown at 20%. So the PEG ratio is 1.1. It doesn't seem to be a very consistent company. I don't know how reliable this is. I mean, they didn't manage their inventory well, so they're discounting, and the whole supply imbalance from COVID caused problems for the company, I'm sure. So I don't know. This doesn't seem like a company I could buy and hold, because if you look at the total return of Intel over time, if you bought this 20 years ago, you'd have like zero gain. Let's look at the maximum. Okay, so if you bought the stock, this is 2009. Since 2021, it hasn't really gone anywhere. It's been flat. Okay, so it is a dividend-paying stock. So I guess that's one reason why people would own it. But right now, it seems like it's has a lot of competition. They don't have an edge. They don't have a monopolistic like grip on any part of their product lines. So that's why it's like it's pretty inconsistent and not reliable. And with this earnings report, you have two earnings reports that have negative. Um, they didn't report. As good as expected. So I don't know. It's still a stock that's not that great. So its PE is 17. These numbers are good. Profit margin is 19, and the return on equity is 14. What I did was I compared against Taiwan Semiconductor. Way back here, we did this same chart, and we said which would do better over time, Intel or Taiwan Semiconductor. And at the time we had Intel. It was losing market share for the servers, the server application for their products, and to AMD, and people were farming out a lot of their functionality to Taiwan Semiconductor, and they kind of lost their edge for manufacturing semiconductors because they didn't really do that anymore. And it turns out that Taiwan Semiconductor, which is purple, which S&P is red. Okay, so the S&P did better than both of these over the past, 2 years. So, and this is Intel right here. This is Taiwan Semiconductor. So, looks like Taiwan Semiconductor did a little better in the last 2 years. Joe, you're involved. No, you're involved with this stock, aren't you, Joe? You followed it a lot?
Okay. I bought Taiwan Semiconductor last year.
Oh, good. Oh, right. Yeah, so that's Taiwan Semiconductor is they're doing a lot of chip manufacturers in America last year were farming out their chips to Taiwan Semiconductor to make, and now they're kind of turning that around and they're manufacturing in America, and there's a big push by the government from the United States to manufacture chips in America. That it's kind of like turning that battleship around at Intel. It's going to be really hard, and when you're an investor, you got to think, do I want to sit through a turnaround and wait 10 years for this to be growth stock again? Any comments on that? All right, no comment on that. Okay, so
quick question on your comparison between Taiwan Semiconductor and Intel. Are you sure they're in the same exact business? Because Taiwan Semiconductor created a conductor, where Intel actually created chips.
I thought Taiwan Semiconductor created the chips. I thought they manufactured chips for other companies as their main product. So you design the chips in America, and then you just have them manufactured over there and sent back.
I know the main business is creating a conductor for creating a chip.
I have to research that. I'm not an expert in that.
But yeah, Intel is very disappointed. I do have some Intels for the fact that they were looking forward to their restructuring, and seems like the restructuring doesn't work well, but they are in the process of restructuring for the last years, a little bit over.
Yeah, they hired one of the original designers of, let's say, one of the earlier processors for Intel as the CEO. So this he's basically trying to turn the company around and manufacture in America. But I don't know. It doesn't seem like I would want to invest in that company for a long term, because it's too. This industry is too fickle. Number one, people pre-order, they order too much, then you got to get rid of inventory, and then but almost every one of these stocks in this semiconductor industry is it goes up and down, and it's just nuts, and it's all based on supply and demand for this industry. So even if you're the best company in this industry, you're at the mercy of the supply and demand for chips.
Can you compare Intel with AMD?
Let's do that. Let's do that. I think
that's more an apple to apple.
Yeah, right. Let's do that. Let's see, AMD. We'll compare that to right there. Oh, look at that. So they're about the same going back to 1993. Just look at last year. AMD was outperformed in a major way. Now AMD is almost just a little bit outperformed over all that time. How far do you want to go back? Like 5 years?
I mean, recent, so 1 year.
Okay, yeah, let's go 1 year. Okay, so Intel is the purple and AMD is the blue. So AMD is kicking their butt. Let's go back 2 years. Yeah, they kind of trade together. Okay, so AMD is taking market share from Intel for sure. We knew that last year, but this year, yeah, the problem with Intel is they don't have any proprietary advantage over their competition. They don't have a better semiconductor. They can't make more than their competitors. I don't know. It just
It's too much focus on PC and server, whereas I think AMD actually diversify out a bit further.
I think Intel started getting into for cars that are self-driving. Mobileye, they bought Mobileye, but I think they spun that off, so they don't even have that anymore. I don't know. I think this whole industry is confusing. I can't even with AMD, their numbers aren't that great. If we look at the numbers for AMD, the statistics, I still can't rationalize a purchase of that. It looks like we have this momentum in the stock market coming back. 4P is 19, PEG ratio is 1, so it's fairly valued. Yahoo thinks it's growing at 19%. So if we look at let's look at E-Trade. So it's AMD isn't cheap right now. It's still pretty pricey.
Yeah, I have a bit of AMD also.
Okay.
So that's balanced myself out.
Yeah.
From the loss on the Intel.
Oh, right. At least you get a dividend with Intel. It pays a little dividend. Okay, so we're going to look at the AMD just to see. Jim Cramer likes this stock a lot because of Lisa Su, the person who's running the company. Okay, well, you can see the okay, let's look at 3.59 divided by 4.68. 25% growth this year to next year. 4.68 divided by 5.94. 20, it's 32%, no, 22% growth the year after. So it's growing around 20%. Its PE is 20. So that's a nice straight line up. So that's not bad. It's an okay stock. It's just they're there was just a supply and demand imbalance that caused this volatility recently. So let's look at, okay, so I don't know, Jim Cramer likes it. Let's look at the numbers here. The profit margin is 10%. That's not great. That's okay. It's not great. Return on equity isn't that great. It's 7. We like 13 or more. So, all right. So it's like a fairly valued stock. For me, it's not interesting. It's not very consistent. Let's look at some more things that I have on my. Okay. Valuation. Let's look at valuation, and we have the emotional chart here. It seems as though I was thinking we were here last week. I'm thinking we're getting to a point where we're taking off. We're breaking out of this downtrend. We're going to get a point where there's going to be media attention. We're up 15% this year. Everyone's piling in. There's a lot of cash on the sideline. We're going to start getting enthusiastic. God, I'm sorry. Okay, so with the S&P on a verge of a breakout, we could have this momentum, fear of missing out rally, where people just they see on the news it's going up. We're up 10% this year. Everything that was down last year is going up. Well, I better jump in. It's fear of missing out. So right now the primary emotion in the stock market is greed. So we're getting this media attention. We're breaking out. Everyone sees that same breakout that we're pointing out. And if we get some good earnings report next week, we're gonna like totally go above the moving averages. But you got to be willing to, if we have a bad earnings report, you got to be willing to go through this capitulation phase. If you're a long-term holder of a stock, but you got to always keep this in mind. You want to buy low and sell high instead of, buying high whenever people are delusional. And last year, right around this time, we were talking about Kathy Woods and her ARK stock, and even now, the stocks that she owns are pretty delusional, but people have fear of missing out, and they're going to start buying her ETF because, for the same reason, delusional, she's a wonder worker, now people are just delusionally going into buying things randomly. But if we do have the smart people we're following say we're going to go sideways, I don't know, sideways 50% chance. For me, I'm buying and holding, and I'm just a market observer right now. And every time I get a couple $100, I try to dollar cost it into positions. But anything else? Let me see. Okay, so we're coming into February. That's one of the lowest returns of the year, and that's primarily because we don't have earnings reports during that month, and so it's like a drab month. Not a lot going on. We do have the Fed talking the first of the month, so that'll either help or hurt the stock market. A lot of things going on next week that'll help or hurt. So if we get some kind of indication that this Fed is not going to raise rates anymore, that'll kick us out of where we're at now. All right, so let me see. Are there any stocks anyone wanted to go over? Okay, let's look at Tesla, just because it's a stock we've been following, and it's gone up recently. Let's look at that. It's up 10% today. They had a good earnings report earlier this week. Let's look at the full screen. I think it was just two weeks ago we were saying, let's look at this. Okay, so it was down to, no, it's not giving us good numbers.
It jumped 10% today.
Yeah, it jumped 10%. That's pretty amazing. We look at the fundamentals on Tesla. Look at that. This is an example of the PEG ratio going down to 1 2 weeks ago. We waited for a long time for it to go down to 1, and it bounced off of that. So right now it's around 38 times over, not 38% overvalued. Doesn't have a lot of numbers. What happens with all these numbers? I don't know. But I think there's a lot. I think what's happening right now is a lot of short covering. We had this whenever we have this downtrend like this, and it's so predictable. We've been predicting this basically since it started, and whenever you get to a point where you do have a breakout and it has some momentum around it, you have short covering, and then stocks tend to explode at times whenever they're high short interest. So there's a lot of people that follow the highest shorted stocks, and they try to invest into those, seeing that whenever that you have this possible breakout, then people start covering their positions. Maybe that's that. I don't know what else would cause that.
For in terms of short selling and short covering, when the stock go down to when they actually try to buy the stock to cover for the short sale position, wouldn't that causing the demand up, and
right,
and therefore the price gonna go up further?
Well, right. So people bet for Intel stock to go down, right? And there's some major news that, like, let's say they bet for Tesla to go down, and they shorted it down to like $100 a share. Then, Kathy Woods is buying that every day, so you have some kind of demand there to begin with. And then once you get some kind of good news report like we got this week, then people start buying to cover their shorts. So they have a short position, like a put position. You have to cover that, otherwise you have exponential losses if it keeps going up. So that puts added pressure for the stock to go up. Okay, so we know this is a volatile stock. It's overvalued. So for me, it's whenever I see something like this, that's like a PEG ratio of 1.3, that went up 11%. You say, I just missed that, and just find somewhere else to look at. But let me see. It's still down a lot from where it was trading at before. See. But the one problem with Tesla is that there's no growth after a couple years. It might turn into a regular car company with competition. So if you have, let's look at their earnings projection there. Okay, so we were 6.35 divided by 7. Okay, 15%. They projected for the year 25 to 26 2 weeks ago. It was 5% growth. So that means that they would have turned into a regular car company, but that's turned into 15% now. So they're growing 4.07 divided by 5.59. So 30%, 5.59 divided by 6.35. Okay, so that's 12%. So they're growing at like 12 to 15%, and their PE is 27. So that's double the price they should be. So if you want to look at Tesla, the price of the stock that you would buy it at for a fair value is 100. So that was a good little exercise. Okay, let's look at we have a couple minutes left here. Look at the news on. Okay, so people are piling into ARK now. this Woods arc on best pace per month. There's actually a stock that shorts the arc, so there could be short covering on that. And as people are getting out of their short position on ARC, they could be helping Tesla because Kathy Woods is buying Tesla whenever people put money into her fund. So that's really a good reason why Tesla is up 10%. You see, we were talking about Bed Bath & Beyond, how it had nothing but negative numbers. And when we look at they're going to declare bankruptcy pretty soon. Let's look at their fundamentals. Okay. Okay, so you see, look at all that negative earnings reports, and worse than expected, all negative. All right, so this is a super dangerous stock. The latest, market action was people were buying this from $1 a share to $2 a share, and it was the most active on the stock market. And it's just totally speculative because it's gonna declare bankruptcy pretty soon. But whenever you see negative in the earnings projections, they only have so much time to have negative earnings before they run out of people that would fund their operations. And it gets more and more expensive with interest rates going up to borrow money. So this company, look, they're up 1.79%. That's weird. But you stay away from those kind of stocks. One more thing I wanted to show. Is there any comments? All right. I want to go over some of the statistics on. We still have a downtrend for a lot of these indexes, but you can see majority of the indexes we have a small little breakout, and that's just an indication that we're at this right here is the communications sector. This is probably why Verizon, AT&T are starting to do better now, is because they've broken out of this long-term downtrend for the communications sector, and people are starting to buy those now. Healthcare, they're probably going to go sideways for the next year or down. Okay, retail sector, real estate sector is starting to break out just a little bit. Okay, energy, this continues to have an uptrend. This is just amazing that it continues this uptrend, but we're going to watch if it ever breaks out of this to the downside. That's a very good indication that the energy trade is over. But for the price of oil, it makes sense that with the strong demand from a China economy and economy in America that's doing okay, the price of oil is going to go up, and that helps energy stocks. We're just watching this uranium. That we got a tip from the other day from a manager. He said, watch uranium. Seems to be in this pattern right there. He thinks that, who was it? Dan Niles. He says that uranium will do well because of energy, of demand for clean energy. It's not panning out yet. We'll watch that. You see, seems like the drug stocks are going from a uptrend to a sideways pattern. So they're going to drop into like a dividend paying this year to go down or go down. Let me see. We were tracking Alibaba ever since it broke out of this long-term downtrend. It seems to be one of the best stocks in the S&P this year, or in the last couple months. It's still a crapshoot because we don't know what the Chinese government's going to be doing. Alphabet, you can see it started to break out of this long-term downtrend. So a lot of the tech stocks, they're reporting on Monday. If they have a great report, that's gonna be like that's gonna break them out of this long-term downtrend. And let me see. What other stocks did comment? Yeah, Amazon is still in a downtrend. It hasn't broken out at all. So we'll keep watching that. Apple broke out just a little bit. And
Amazon went up 3% today.
Oh, it did. I didn't. Okay, I wasn't on this. So maybe it did break out. So you're seeing these little breakouts of these downward trends, and you add that momentum. There's a fear of missing out to get investors greedy. That's all an indication that we're going to have some kind of momentum out of this, and it all revolves around next Tuesday when we have the Fed say something. We're not raising rates anymore. If that happens, then they're not going to say that, but they're going to say it's data dependent. They're going to raise it 25 basis points and then say we're data dependent. So then I don't know, but I think next week
Amazon break out because it just lay off a big chunk of employees. So in Google.
Right. Google went up 5% when they said they're laying off a lot of people. They're reducing their costs. I don't know. The problem with Amazon, they still have a PE of 70. That is still like outrageous. I think they're a leader in the cloud. I think their cloud business is worth more than their company is trading at right now. That's why I still hold it. The statistics. Let's look at their PE. The PE is 50. In this environment, they're not growing at 50, percent. They're only growing like what, 5%? That's MZN. So it's super pricey still. They've always traded in a super pricey way. Let's look at, just for kicks, what their earnings are estimated to be. Okay, well that's a lot. Okay, let's look at 1.61 divided by 2.91. Okay, they're growing 45% next year. This year to next year, 2.91 divided by 3.89. And 35% after that. So, we have to say, is it worth paying 50% to something that's growing 40%? So it's up right around its fair value. It's over its fair value by, it says, look at that, Yahoo says it's over 5 times its fair value. So it's only, Yahoo thinks it's only growing at 10%. And these numbers here say it's growing around 15 or 20%, or 40% for the first year and then less after that. So, I don't know, it's still pricey regardless. But I've actually, this is one of the stocks I reduced because I thought it was trading at a very high PE ratio. And I was trying to get more into dividend paying stocks to be more consistent, to more conservative. So let's look at, let's see. Okay, so what else do we have to say here? Well,
somebody asked a question about why TRIs jump. Did we find out the answer? But I mean, sometime back, not recently.
Let's look at TRI just because we're following that company. TRI had a lot of debt, and that limited their growth before. I think they got rid of their fastest growing part of their business, which was the what Refinitiv turned out to be. Look at that. They don't have many people following them. It's only going up. Estimates only go up for 1 year, but 2.48 divided by 3.18, 23%. So they're growing at 23%. Let's look at TRI. They're growing at 23%, and their PE is 50. So they're double what they. Forward PE is 36. Okay, so that kind of makes sense. They're like 1.4 times overvalued. So it's not that exciting. I mean, I thought they have a news business. They have some accounting software. They don't have they have like a shell of what they used to have. I'm not sure exactly what they sell anymore. But what do they actually do? They have the news service. Well, let me see. We can look at the profile to see what they actually do. Business information services, tax and accounting professionals. Okay, so they sell stuff for legal, corporate tax and accounting professionals and news. I guess that's what they do. So they make a lot of money with selling to law firms, governments, to be compliant with government regulations or whatever. I don't know. So I have no answer. No answer why they. But let's look at the earnings estimates. They've done better than their earnings estimates. That's a good reason for them to continue to go up. If you have a lot of these negative, they didn't meet their estimates, that contributes to less confidence in the stock. I don't know. It doesn't look like an enticing thing for me to invest in.
I know Mark have a lot of Thomson Reuters stock.
Yeah.
I'm wondering whether he's selling some off during the high peak.
What do you think, Mark? Well,
No comment.
I'm holding. I haven't sold. Yeah.
You still holding?
I'm still holding, and I'm still upset that time when there was the stock buyback and you had to opt out of it, and I did, and they claimed I didn't, and bought my stock back at what now is a bargain.
Oh.
No, I'm still holding over 2,500 shares, so.
Wow, that's pretty cool. All right, well, I think I've used more time than I'm allowed, so I think I have to stop right now. All right, well, thanks for attending, everybody.